Minutes released at yesterday's Federal Reserve meeting indicated a new round of quantitative easing was high on its list of priorities. Today I'm joined by Jean-luc Proutat, head of OECD Team at BNP Paribas, to discuss this. Now Jean-luc, can you tell me more about the possibility of a new quantitative easing programme, and when do you think it may be implemented?
So yes, it's very likely that a new round of quantitative easing will take place in the US, but this is not yet a done deal. It will depend, as the minute were saying, about the evolution of the macroeconomic picture. But to our view, it's very likely that a new quantitative easing will start before the end of this year, maybe September, maybe later, but something between September and the end of the year. And quantitative easing means that they will buy probably long-term assets like mortgage-backed securities, and they will put liquidity into the banking system.
Do you think bond buying is the answer to the Fed's problems?
It will not provide any miracle, but could be an answer, because we have seen, for example, the long end of the curve, and for example, if you look at the mortgage rate, they have come very, very low, and this was mainly thanks to the Fed actions. So it could help for a continuation of a very, very low interest rate on the mortgage market, which could help the housing market to continue to recover. I mean, it could work marginally, but on the other part of the market, I mean, looking at the Treasury yields, for example, they are already very, very low. The other point into my mind is that this kind of action, quantitative easing, and maybe also extending the forward guidance to the market, for example, telling the market they will not do something before 2015, this could help to keep the dollar at a very low level on the forex, and this is also, an help for the US economy.
What other options were suggested in order to boost the US economy?
The other option is to extend the period of time that the FOMC will say that rates, for example, will keep at extremely low levels. We know for the time being that this period of time is up to 2014. The FOMC could tell the market it could be delayed by 1 year, for example, to 2015. And this is in order to keep the anticipation as low as possible for a long period of time. We know that the interest rates are already close to zero, but it could act on the time and the timetable. It could be a possibility that the FOMC tell the market that they will not act before, let's say, 3 years. It's a part of an action that could be made.
What do you predict to happen at the Fed's next meeting in September?
I would say not necessarily start of a new quantitative easing. They could postpone the decision until October or November, for example. Probably a very dovish message, as the minutes suggests, and extensions of the forward guidance they give to the market. Maybe not 2014, but maybe 2015. And they will tell the market they will keep very, very low for maybe a longer period of time that we were thinking about before.
And finally, Jean-luc, what are your main fears for the US economy?
One of the fears is what is shared by many observers, that about, the fiscal cliff and the expiration of the push tax cuts at the beginning of next year. But again, we can take the view and the bet that something will be done from your new elected president and the new government at the start of next year in order to avoid or to soften this tax shock. But this is a concern. If nothing is done on the budgetary front at the start of next year, it is very likely that the US economy will experience a recession. But again, it is a political issue and very difficult to answer at this stage. But looking at the underlying trend in the economy, I'm pretty confident that the US economy will continue to keep on growing. More precisely, looking at the housing and the property market is doing better.
Thank you, Jean-luc, and thank you for watching Dukascopy TV. Stay tuned to hear more about what's happening in the markets and the global economy. Goodbye.